Good morning, and here we go. It's half an hour to the open. Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Annabelle Droulers.
Our top stories. President Trump announces sweeping tariffs on all US trading partners, seeking to dismantle an economic system he says has hurt America for decades.
Now, China is set to be hit the hardest, with the US levies rising to more than 50%. The offshore yuan is trading near its all-time low.
But the pain's being felt across the Asia-Pacific as additional taxes on Vietnam, Taiwan, Japan threaten to reshape the global supply chain for cars, chips, pharmaceuticals and agriculture.
It's going to be Liberation Day in America, and it's going to be a day that hopefully you're going to look back in years to come and you're going to say, you know, he was right. This has turned out to be one of the most important days in the history of our country.
That was President Trump speaking after he announced tariffs on all US trading partners around the world, with the Asian regions some of the hardest hit. Taking a look here at some of those tariff rates, as we said, a minimum 10% tariff on all exports to the US, additional duties on around 60 nations with the largest trade imbalances. So the tariffs taking effect after midnight Saturday, higher duties kicking in on April 9. And as you said, David, really a lot of the countries that are being impacted the most are the ones in this part of the world.
Yeah, and we're looking at a lot of these markets, including, of course, to your point, Southeast Asia opens up. And a lot of these markets are coming online, like Vietnam, for example. So the China Plus One strategy, the diversifying your supply chains away from China, going into this other gateway markets, perhaps now that we need to be talking about certainly that strategy right now. Now, sweeping tariffs just about across the board, sweeping risk aversion is really one way to describe what's happening across these markets. So we are called substantially lower across these equity markets. So we're looking at about a 2% drop. Can we get back to that screen, please? I'm not done. When you look at European equity markets, so case in point, really, you could draw a straight line between really where the more aggressive tariffs came into play more than expected, what the market was expecting, and the drop we're seeing across those specific equity markets, like Japan, for example, which is up about 3%. Asia, we're off by about 1%. We talked about Haven Place. We're coming off lows today on the Chinese currencies. Let's have a look at that. 734 earlier on. We're at 731.32. as we speak. So we're still within striking distance of all-time lows. Doubt that we get there today. The fix, of course, will be very much in focus today, and how the PBOC anchors expectations going into the session right now. Yen was stronger by about 1%. We're coming off that one as well. Right, very, very quickly, EMFX, very much in focus. South Korean won is extremely near that high, or dollar won, extremely high, that high that we hit back in December. Beyond that, it's 2009 levels. We'll talk about Southeast Asia a bit later on. Bond markets, here we go. Japan down the most. 10 basis point move earlier on the 10-year yield. We're looking at a substantial drop as well on a lot of the banks. So it seems to be that Japan might be liberated from any sudden rate hike coming out of the Japanese central bank coming this summer. 10-year yield, we're off by 5 basis points. We were down as much as 10, so we're coming off a little bit, but make no doubt, it's still a day of risk aversion going into the open today.
Yeah, that's right, and it really, it's going to be felt in a lot of different ways, and certainly is going to continue to be our top story for quite a period. But let's get more on this now. Bring in Bloomberg News editor John Harney joining us, as well as our chief North Asia correspondent Stephen Engel. And John, let's start with you. And yesterday we were talking about how these discussions and deliberations were really coming down to the wire of what the White House and the Trump administration would be planning. How did we reach this point, and also the way that these levies are being calculated, because we know that they're based on a government tally of certain duties and also non-tariff barriers. How do we get to these calculations as well?
Well, that's sort of complicated, but one recurring theme here has been Donald Trump, since he began his political career, and even before that, has emphasized the decline of American industrial might, which he says has been brought about by trade deficits. In the White House fact sheet that came out, I'll show you shortly after his Rose Garden announcement, it said that America's manufacturing base has been hollowed out by unfair trade practices of other countries. This is encompassed, as you point out, in many countries, just about everybody. In China, of course, our chief adversary, and Japan, a very important ally. Now, as you also point out, this includes value-added taxes, which, of course, not only American companies, but countries and within these companies in these countries themselves also pay. So it's all a little bit murky at the moment. But again, this is what Donald Trump ran on, not just in 2024, but in 2020 and 2016.
Steve, let me bring you in. Zhang Shu, chief Asia economist at Bloomberg Economics, Steve, points out that Liberation Day turned into a worst-case scenario here.
Yeah, so we have to dig into the numbers, and Bloomberg Economics really has, because if we look at the cumulative effect of the tariffs so far in the first couple of months of the Trump administration, 10% first, then another 10%, both on the fentanyl issue, now another 34%, so cumulative 54%. But Zhang Shu at Bloomberg Economics also points out you need to take into account the tariffs that were in place before then, the legacy tariffs. So they're calculating whether the White House is looking at this as 54%, the real tariff could be as high as 68.8%. That's dramatically higher than any worst-case scenario that most people put forward, and it's much higher as well than Donald Trump talked about on the campaign trail. I remember the Macquarie economists were talking about that could be about a 2% tax on GDP if they went to 6%. Zhang Shu is estimating 2.3% of Chinese GDP could be at risk due to this level, 68.8%, because it's not just the dramatic drop-off of trade between China and the United States, but it's also the reciprocal action from around the world on the United States as well, and also the kick-on effect of the China plus one strategy, all of these Southeast Asian economies. If you look at Vietnam, Thailand, Indonesia, Malaysia, Cambodia, Laos, Philippines, all of them were given or handed sizable U.S. tariffs. Vietnam, 46%. So that's going to have a knockdown effect as well. And Zhang Shu also pointing out that we could see cross-Pacific trade between China and the United States drop by up to 80% over the medium term. So this is a seismic shift in globalization for sure.
Yeah, they're certainly being hit twice, really, not only by these tariffs, but also by their appeal maybe as investment destinations for that China plus one strategy. But John, we had an interview earlier with the Treasury Secretary, Scott Bessent, and he's essentially urging countries not to retaliate against these tariffs. Is that likely to be the policy that governments follow? We've already heard from Australia, for instance, this morning. Prime Minister Anthony Albanese is saying that they wouldn't push back.
That's true. Mr. Albanese also called it a very poor decision. It's going to take some time to see how the reaction is and at the surprise once the surprise wears off. Mark Carney, the Prime Minister of Canada, of course, promised that there'll be an announcement regarding retaliation tomorrow. Now, Canada and Mexico were largely spared from today's tariffs, but they still have 25% tariffs that were imposed last month. So it's all a bit murky, as I said, and the president has what's called a moderation authority, which allows him to decrease tariffs. So a lot could happen between now and April 9th, when all of these tariffs are scheduled to go into effect.
Steve, just your comments there. Scott Bessent, of course, coming out. Plus, how do we need to be thinking about supply chain stuff?
Well, obviously, we need to look at supply chains. Look at a company like Apple, who has manufacturing not only in China, but they've diversified to India, Vietnam, Malaysia, Thailand, also the components in Taiwan. So that's the reason why the stock fell in after hours by about 8% overnight. But again, the biggest issue is what kind of retaliation are we going to get from the Chinese, whether they do it now or wait till these are actually implemented on April 9th or April 5th when the first 10% is imposed. And how are they going to resolve this fentanyl issue for the first 20%, because the Chinese are not even acknowledging publicly that it's their problem. It's America's demand problem for the illicit drugs. This is what Scott Bessent had to tell Anne-Marie Hordern on the lawn of the White House earlier this morning.
I think China said today that solving the fentanyl crisis depends on taking off the fentanyl tariffs, and I'm pretty sure that's not the way the sequencing is going to work. They're exporting the precursor chemicals, and every day, every week, every month, Americans are dying, and it's going to have to stop.
There's just so much to unpack with this story, too, because China is also, the NDRC has come out, or no, they haven't come out. Sources have said that the NDRC, the top planning body in China, has instructed companies to hold back on investment in the United States. The real big question right now is what are those levers that they're going to pull, or are they going to keep measured response, which they have so far. But now with that effective tariff perhaps as high as 68.8%, I don't see China sitting still.
Team, fantastic. Stephen Engel, our Chief North Asia correspondent, and John Harney there, of course, our Bloomberg News editor. Just to note as well, as we go into the open today, we're called substantially lower. And just to also note that today we have the foreign ministry briefing out of China, plus I believe we also have the commerce minister also coming up, commerce ministry coming out with their own briefing as well. Stay tuned, of course, for that towards the afternoon. Speaking of commerce, U.S. Commerce Secretary Howard Lutnick following President Trump's Liberation Day until that's coming up on Bloomberg Surveillance at the Times on your screen to catch that, of course. Yeah, lots more on deck here today.
Yeah, that's right. Also taking a look at sort of the FX implications of this as well. We've seen dollar weakness off the back of this being announced, but we've also seen a lot of other currencies reacting. Goldman Sachs, for instance, really doubling down on their yen call, but we'll have more ahead with Standard Chartered joining us for a closer look at the impact on G10 broadly, counting down as well to the open of trade in Shanghai, Shenzhen, Hong Kong. As David said, this is really going to be risk-off as traders digest these tariff announcements just in the past few hours. You're watching The China Show. You're watching The China Show, taking a look at how markets are setting up. We're 15 minutes away from the open this morning and guiding, of course, for a very risk-off session. What we are digesting today is tariffs on Chinese exports to the US that pretty much exceeded everyone's expectations. So a 54% tariff on imports from China into the US market. Again, this is going to be something that we're going to really be watching for any sort of retaliation from Beijing. How are they likely as well to fare against this?
Yeah, we're just waiting for the fixer today because that's going to be quite a landmark today. In a sense that when we woke up in the Asia Pacific this morning, the offshore rate CNH was actually within striking distance of an all-time low. It's come back a little bit. The fix is now out 718.89, which I think on an absolute basis should be near the highest of the year. I'll correct myself if I'm wrong. We're looking at that. But that being said, we haven't seen a 718, 719 handle for a while here on the Chinese currency. The reason that's important because that is, of course, the 2% handle and where we go from there as far as the limitations of how far we can go on the onshore rate. 732 right now. As you can see, we've come off highs of the day on dollar China so far, going into the onshore open.
Yeah, you certainly saw it extending those losses. But let's get more on the FX market and the G10 complex, actually, with Stephen Englander. He's Global Head of G10 FX Research at Standard Chartered Bank. And Stephen, if there's any sort of broad move that we've seen so far as well, has been that move into havens. We've seen, for instance, moves in the Japanese yen, Swiss franc. How long do you see this lasting?
Yeah, I'm not sure it's going to last forever. The havens are hard hit. The tariffs on China, China is, low beta currency, euro, yen, Swiss are very high. And they're way outperforming countries that got, Aussie, Kiwi that, were kind of left relatively untouched. I think this is a feature of how the market behaves when there's a lot of uncertainty in the air. I think once things settle down a little bit, especially because they're low yielders, I think that they might fall back. Now, it's not that I don't think anyone's going to do great against the dollar, but I think this outperformance of the safe havens is something you want to keep an eye on to make sure it's durable.
Stephen, David here. We were talking during the break. The fact that these tariffs that were announced came in a lot more aggressive than the market had been expecting, most, not all. Might sound counterintuitive. Might this actually be the worst case scenario, and might this be a good thing? We now have clarity on how far the defense actually goes.
Well, no, I don't see it as a good thing. I see it as a negotiating strategy, right? That even countries that have a trade deficit with the U.S. are tariffed up at 10%, and on the assumption that they must be cheating at least 20%. So, you kind of say, go figure. I think that, the fact that Canada and Mexico were let off the hook for a bit, I think it's clear that they have logistics problems with tariffing up goods across the border because of the degree of integration of the three economies. But Besant didn't say never. He said not yet. So there may be a shoe that's going to drop. We have retaliation that's coming. So I think that this isn't the worst case scenario. I think that the market is still digesting, and when they digest, they may decide it's pretty bad.
Yeah, and I guess a lot of the concern is that this becomes something that's growth negative, these duties. So do you think we're setting up for a dollar negative story then?
Ultimately, no, because I think at the end of the day, the risk off is going to be felt globally, and the dollar will still be a safe haven, and if you read the if you went to the after party where you had comments from Besant and other officials on the U.S. side, they keep talking about their desire to have an aggressive fiscal bill, and this is part of it. Part of the reason you are so aggressive on raising tariffs is you want to collect the revenue so you can cut taxes. So I think the fiscal bill is going to be an important part and give stimulus. Ultimately, I don't think that they're going to pay for it. So I think that U.S. yields are going to go up, and I think that will be dollar positive, not for the next 100 years, but say, for the next year or so. So we're more dollar positive, certainly from here going forward, than we are dollar negative. And I'm actually a bit surprised that the dollar is weaker off this.
Okay, I was going to ask you then about the Fed, because they have now two almost contradictory objectives. Do they have to worry about the inflation effect of what was announced, or is it the activity numbers that they have to worry about because of the same announcement a couple of hours back, Stephen?
Ooh, I think they're caught behind the 8 ball on this one. That it's unclear. You can make a case that this is going to be a one-off, that it's going to be a relative price change, a price level change, not an inflation change, so the Fed shouldn't react. That's what the administration is saying, and even some of the Fed people have acknowledged that as a possibility. But if we start getting weak numbers, that's going to be the bird in the hand, and I think the Fed is going to react to it. I do think that the market is way or somewhat too kind of aggressive in terms of the Fed cuts, because the Fed knows that, say they cut what the market is pricing in, about 85 or 90 basis points right now through the end of the year. Taking that back is going to be hard. So I think the bar for Fed cuts is higher now. We think they'll cut twice, but I think that they won't cut as much as the incoming data suggests they should, because they're afraid that it will be very difficult politically to take it back once the fiscal stimulus hits.
What do you think then that means for the euro as well? That Fed dynamic plus the duties that have been applied to goods from the EU bloc?
I think it's actually euro negative at this stage, notwithstanding that the euro's, gone from 108 to 109. It looks like they're going to retaliate. It looks, it certainly didn't look as if they got the heads up on what was going to happen. And I think that it's going to be a nasty set of negotiations going forward. And yes, Besant is correct in saying that these are maximum tariffs, but they're maximum because even if you cut them in half, they're still pretty high. So I think we'll see some euro weakness ultimately, and then we'll see how quickly the market digests and makes that assessment.
Stephen, final question for you. Any specific currency, any specific pair that presents a trading opportunity short term to you?
Well, you have to look at UK versus Europe and kind of say, well, UK tariffed at 10%, Europe at 20%. That looks pretty good. Swissy got a whopper. I mean, and it's a low yielder. So, within the set of Even yen is a high yielder compared to Swiss. So, you could consider long Swiss, short yen as an attractive proposition. And I'd say overall, cautiously, I'd say that, the market's going in the wrong direction. Nothing that stops it from going even further. But I think that the dollar weakness here at some point will be reversed.
A lot of head-scratching moves today. Stephen, fantastic, and thank you for really an important point of clarity as we go into really the next couple of hours. Stephen Englander there, Global Head of G10 FX Research at Standard Chartered. Right, just 8 minutes to the opening bell. It's not looking pretty out there. Hang Seng Tech is off 3%. Every single stock is down on the benchmark. This and the next page will show you another 4 coming through as well. The open, 7 minutes away. You're watching The China Show.
5 minutes away from the open of mainland markets this morning, and we are setting up for very risk-off trade, of course, being caught up in what is the global market dynamic, and also global investors who are reacting to tariffs that came in worse than a lot had feared. So some of the stocks that we're watching in particular, these are the e-commerce names, also being very sensitive to the closure of the de minimis tariff exemption. So these were packages from China and Hong Kong that were worth up to $800 from China to enter the US duty-free. So that loophole is going to be ending on May 2. And you are seeing that very strong reaction coming for the names like Alibaba, JD.com, for instance, as well. This is really, again, the story around China in particular is going to be one to be watching very closely, given that the total US tariff rate on Chinese goods has now risen to 54%. That's once the US has already imposed the 20% tariffs on Chinese imports early this year, so adding to those as well.
And, I think what sort of underscores let's call it a negative surprise, right? Because, people talked about the worst case scenario for China would be a 60% tariff further down the road. We're effectively there at 60% very early on. So we'll see how markets adjust this. And we have a lot of guests coming up on the show to help us unpack what this means for your markets. The open is next. This is The China Show.
Welcome back. You're watching The China Show, counting down to the start of trade in mainland China and Hong Kong this morning. Unsurprisingly, we are guiding for a risk-off day. We've had Trump imposing tariffs overnight. Basically, no country has been spared here because it's going to be applying to US trading partners worldwide a minimum of 10% on all exports to the US, additional duties on around 60 nations with the largest trade imbalances, and chief among those, of course, is China, where overall duties now are at least 54%.
Yeah, let's call them near the upper end of the forecasts, really, quite early on. And, Southeast Asia is also going to be very much in the mix, and we'll look at sort of the Philippines comes online. We're already seeing some pressure across EMFX. Just on that note, the PBOC fix of the day actually might provide you an anchor for risk assets. And, I'm going to stick my neck out here. This is probably why in about 2 hours from now we're going to be coming off lows of the day. That's what I suspect. Because we are coming off 734, 731, and with the fix right now at about those levels. So flip the page, please. Worst case scenario is largely on the plate and visible right now for markets, right? So as Scott Besson said, don't try and renegotiate and retaliate, right? Because if you don't, that's as bad as things can get. So the numbers are quite on the upside. It's further in terms of market, in terms of breadth, a lot more coverage globally, every single country. If you think about it, 2%. Right, okay, 2% to the downside right now, Hang Seng Index. Hang Seng Tech, every single stock is down, 10 cents all the way through to Xiaomi. So you have to look at the big winners to understand really where the big losers are going to be. So Chinese tech is one. You have some of the chips. Number two, automakers have been pummeled in Korea and Japan. You have the banks, of course, as people rethink the timing of when rates can go up in Japan as well. Yields are down just about across the board. Right, we mentioned the currency, the Chinese currency and the fix, right? The fix today, now the figure might sound nominal, 718.89 is the fix of the day, right? So as you can see, that's how the PBOC fixed throughout the year. It's picked up, so this would be the weakest fix going back to January. That being said, the adjustment was not as big as the move in the actual exchange rate. So given the level today of 718.89, let's call it 719, the weak end of your Chinese onshore currency today would be just under 734. So that in many ways, that could prevent the offshore rate from pushing past its all-time low today. So there's your anchor number one. In terms of how that looks, 5-6-year look, and the PBOC has been leaning against the weakness right now, keeping the yuan stable. The chart's about to show you that. The difference from today's estimate is 730 pips. You got to thank the power of the Bloomberg terminal, really, for all the data coming through here. Anyway, we could talk about, why don't we look at Chinese reaction here?
Well, I think we really want to talk about that in particular because, you know, there's going to be a lot of countries that are really feeling the frustration of what the US is doing. And what has been really interesting as well, the reporting that we've had in local media here, but the SCMP saying that President Trump is planning to visit Vietnam, Malaysia, Cambodia in mid-April. And so all of these countries are really being hit by the US tariffs. So maybe there's more incentives to do business with Beijing as well.
When we were putting this out, so, you know, I woke up at 3:30 in the morning today. You know, a lot of our other teams were up much earlier than that. So, you know, I was tweeting out some of the tariffs as they were announced. And one of the comments that are quite telling to your point there, what did Cambodia do to the U.S.? I think that was the question that was put out there, right? But yes, Chinese media, and we'll see whether or not this actually puts a lot more pressure in the U.S. too, to try and embrace, you know, more of the spheres of influence now coming out of China, Cambodia and Southeast Asia, of course.
Yeah, and I think to that point as well, I mean, Chinese state media had published successive editorials in the lead up to this tariff announcement, and they were really trying to cool the trade tensions. I mean, it doesn't seem to have worked, but let's get more with our China correspondent, Min Min Lo. So, Min, what's the sort of reaction we've had so far, if not official, at least, through, again, these media channels?
Yeah, so I guess officially, so far, if you look at what China has done in previous round of trade tariffs, they always retaliated on the day the tariffs are imposed. So maybe April 5th or April 9th could be when we could see the actual countermeasures. Official response, we might have to wait until 3 p.m. this afternoon when the Foreign Ministry holds the press briefing. But so far, we have seen these editorials online on Chinese state media Xinhua, the latest one published this morning, saying that this trade tariff rampage by the U.S. is a self-defeating bullying. And also another editorial just citing all of these U.S. think tanks, U.S. analysts, U.S. media, compiling all the evidence, if you will, of how this reciprocal tariff is going to harm the U.S., raising the risk of inflation, unemployment, recession, and hurting American industry as well. Also, there was another article talking about some of the benefits of free trade, citing examples of Tesla and Apple and how they were able to benefit from China's huge market, how American farmers benefit from Chinese demand. And I guess these examples also show where China has the most leverage, right? We have seen how China imposed these tariffs on American agricultural goods. Could other sort of sectors, whether it's tech or other areas, be next in line? We'll have to see. Yeah.
I think going into today, we had this report about China looking, and maybe this could be part of the response, who knows, limiting or telling Chinese companies to limit their exposure and investment in the U.S.
Yeah, so we're hearing this from sources, and it looks like the NDRC, which is the top economic planner, is getting instructions to hold off any registration or approval of Chinese companies looking to invest in the U.S. We don't know how long this suspension will last, whether it's over concerns of capital outflows or national security or because of this broader tariff negotiation, but it looks like maybe the Chinese government is putting this as part of its toolkit for now while they assess the ongoing tariff risks. And of course, it will add to the level of uncertainty for companies that are maybe looking to move their production overseas in order to bypass some of these tariffs. And already we've seen companies like CK Hutchinson and TikTok being caught in the crossfires. And I think China is particularly concerned about not sending the signal that the U.S. can just cherry pick some of the best Chinese companies and dangle a threat of tariffs on national security and force these companies to divest. So perhaps holding back some of that investment is part of the strategy here as well. And if you look at the latest data available in 2023, China invested close to $7 billion into the U.S. That's already a 5% decline on year. So that amount has already been declining over the years.
Okay. this decoupling. Min, thank you so much. Min Lo there, our China correspondent. Let's get the view on the ground, what this means for market shorts and also longer term. Joining us now is Xiaoyan Zhang, Associate Dean of the PBC School of Finance at Tsinghua University, joining us this morning from Beijing. Good morning, and very nice to see you, and thank you for taking the time to speak with us on such a, let's call it such an eventful day as far as news flow goes. Before we talk about markets, medium and longer term, I want to get a sense, what are people talking about there in Beijing as we digest these tariffs coming out of Washington?
Well, many people are, thank you, David, and many people were very nervous as, many things are happening here. We all know people care about this. I heard a lot of people talking about this. We are waiting for the boots to drop. Now it's dropping. Well, one boot is dropped. So what I can tell you is now people care about this. And second, it's not good news. And the market is expecting more uncertainties coming in the global trade and the global capital market. But on the other hand, I also want to say this is not happening overnight. Oh, of course, this is happening overnight, but the overall trade war idea is not happening overnight. During a period of high volatility, I think for investors, the most important thing for them to do is to think about the long run and think about diversification. And today we saw many stocks are dropping, and the currency rate is reflecting the negative news as well as the volatility. But I do want to mention that in China, and as well as in the global market, many people have already been preparing for this for a long time. China's market is quite resilient. And when I talk to firm owners, entrepreneurs, they are anticipating this to happen. So they have been doing diversification outside of China or outside of the China-US, this pair. And for investors, you guys already show, having looking at those numbers, dropping 2% to 5%. And China and the United States correlation is going down. I think for the global investors, it's very important to have a diversification view. How do you want to allocate your money? Not all in the United States or in one particular country.
So what's next then, do you think? The diversification, as you said, preparations are already underway, but is this going to be sped up, do you think? The tariffs, yes, they were anticipated, but they weren't anticipated at this level either. So you've got to think, maybe people are pretty shocked, I guess, by that figure.
Totally. So for that question, I would focus on several aspects. First of all, I think this tariff news yesterday, it's anticipated, but the magnitude might not be anticipated. I think many countries, including China, are trying to fight back. And there are already some raise in tariff in China regarding the farm goods for the United States. Are there more in the future? I think, yes, there might be more. And for other countries, maybe they also need to reconsider their trade positions in the global economy. I think it will be a dynamics going on there. It's not a good thing for productivity or international trade, but that will be going on. That's from the government side. They will play this dynamics. And second, for the investors, what is going on? What can they do? I think for many, because my research is mostly about retail investors, like you said, Annabelle, people are shocked. They see the negative news. The first immediate reaction would be, I will be pulling out. And at this point, I hope the investors can focus on their long-term goal and think about, why do I invest in this capital market? Can I do diversification? And because Chinese market, stock market, so far from January up until now, it has a little rally for the first quarter because of DeepSeek and because of culture and consumption upgrading. So it is doing relatively fine. So people need to rethink about the reallocation of, between fixed income and stock market, as well as global diversification.
Let me then phrase a follow-up question there, because the if it is an equity market, the question now seems to be, is there anything beyond tech right now that investors should be considering, right? And I'm glad you brought up the point that it's a very retail-heavy market on the mainland, right? I believe over 80% are retail investors. So how do you sell the idea of the opportunity in the onshore market to foreign investors if it's very momentum-driven and it's not very tech-heavy, the benchmarks there?
Well, from my point of view, I have been looking at retail investors as well as foreign investors. David, as you mentioned, retail investors, they count for 80% of total market trading volume in China. And in terms of their investment in tech, I think, we have been trying to educate retail investors in China. What we want them to do is they first have the goal for the investment, whether it's for your pension or something else. And the second thing we're trying to do is, I keep saying diversification. What do I mean by that? We have been looking at the CSI, right? It's going down. And it's going down a few percent right now. But we are trying to tell people that instead of selecting individual stocks, you should be allocate your wealth to a well-diversified market index. In terms of tech, if the tech sector is doing very well, it will be reflected in the index. If it's not doing very well, traditional consumption or traditional manufacturing, if they are doing well, they will show up more for those index because the index is evaluated. So we do hope, so far the technology sector has been doing pretty well in China for the first quarter. So I hope the Chinese retail investors, if they are investing indexes, they should already benefit from that. And in terms of foreign investors, I feel the same. For China's goal for this year's GDP growth is 5%. And for that 5%, many of them will be driven by two things. Number one is technology. The second one is consumption upgrade. I think, if you're investing in Chinese stock market, you should be also considering index for regular average investors, and that is the best diversification global.
Yeah, you've mentioned two things that I think are important here. Firstly, the tech. Secondly, the consumption. And I think something that changed earlier this year was the impact of the embrace of tech leaders like Jack Ma, for instance, and also the release of DeepSeek. Now that we have these tariffs that have been announced, yes, they're higher than expected, but what is the actual sentiment of consumers and of traders in China, and what do they pay most attention to? Geopolitical issues and tensions with the US, or the innovation and the signs of technological advancement and innovation and resilience that you continue to see in China?
Okay, number one, for the sentiment issue, I think for the first quarter, the Chinese government, regulatory bodies have been trying very hard to show people that for the past year, the GDP growth is 5%, and we're confident it's going to be 5%. So the confidence so far is in China, it has been pretty good based on the DeepSeek technology development. And number two, for the sentiment, the tariff increasing is going to bring negative feelings to investors, not only retail investors or institutional investors, as well as firms. They are in negative sentiment today, I believe, and they would worry more about the future uncertainties, whether there will be more tariff fighting in the future, and how do each country retaliate, and the global trades will be hurt for a period of time. I don't know for how long, whether it's for the term for Trump or somebody else, right? But then I also want to point out the last point. The confidence level in general is relatively high for Chinese economy inside China. And the two pillars for this confidence is coming from, number one, technology advance, and which is true for all the economies in the world. If you want to be leading economy, you have to do very well for your technology. Especially right now, it's artificial intelligence. I don't think that any country can afford to lose the leading position, especially for United States and China. So that technology in China is doing very well and it's well invested, it's well protected. And number two pillar is the consumption upgrade. And the consumption depends on the income and the employment and the confidence. Because of China so far, like I said, I keep saying this, for quarter one, the confidence has been reviewed. People are relatively upgrading their consumptions. So that's what I see in China. And today, the big news, the top news, headline news, will be the tariff. But I hope it's going to be a short-term one.
Xiaoyan Zhang there. Thank you so much for joining us. That's Associate Dean of PBC School of Finance at Tsinghua University, and hope to speak with you again soon. But taking a look at how Chinese stocks are faring, we're 15 minutes or just over into the session so far, and actually we've managed to lift off the lows of the day. We're still in negative territory, but the story is not looking quite as pessimistic as when we entered into the session.
Yeah, I actually suspected the gains would come further on, but Shanghai Comp, there we go. I'm curious to see how the Hang Seng Tech actually fares, because that's really where the brunt of the selling early on was taking place. It's now, in fact, relatively outperforming the Hang Seng Index right now. We're also just getting some data coming through as well. So Caixin services and composite numbers. This is the PMI is for March. So better than expected, and also coming in higher than the prior month. Okay, let's get reaction right now on the tariffs and what the initial impact likely will be as far as the Chinese economy is concerned. China, of course, has been hit the hardest here by Trump's tariffs. Worst case scenario has really been brought forward. You know, we talk about 60%. We're at 52 or 54%. It's a really odd number, literally and figuratively. Let's bring in Eric Ju from Bloomberg Economics to help us understand there. You guys have put out a reaction piece to this right now. So just to help us understand what you're thinking right now.
I think compared to many expected before the Liberation Day, I think it's probably the worst case for China, or even worse than the worst case we were expecting. I think if you add up all the additional tariff, it's probably already 6%, close, or at least close, or even beyond 6%, as Trump has committed during his campaign. So, but to some extent, you might think that could be the worst news that's already gone. Right? We're already hit by the most we can hit. So probably hope it's not going to go even higher, maybe going forward. I don't know, but I think at least it's showing that it's going to be very tough, at least on the external side, for China this year, right? The higher tariff, and our global team has some estimate that if you for 60% of tariff in the medium term, it can be maybe slashed, about 80% of the China-U.S. trade, or it's about 2 percentage point hit to GDP. Wow. So that's a not small hit, right? So I think that's also means the policymaker have to think more about how to stimulate domestic demand this year, right? So it's
I mean, a 2 percentage point hit to GDP is obviously very significant. So what are the policy tools then that Beijing can pull on to remedy, or at least to
I think most of the tools they have already announced during early March in the NPC. So what measure they're going to do? I mean, the first priority is on consumption. They want to do more to lift the domestic demand, and the second, I think they still want to push forward the high tech development, right? DeepSeek, those AI has been a strong drive for the market this year, and we're also starting to see they're also being supporting to the economy, GDP. So I think this is another direction they want to still concentrate on this year. And of course, at the same time, they want to help people to recover income, have a quicker income recovery, trying to get people to spend more.
We now have a full set of March PMIs out.
Yeah.
What's your sense of how March looked from an activity perspective?
We tend to not read too much into much PMI because, it's seasonally, it's always rebounding, compared to the first 2 months because after New Year holiday. So I think the rebound, the size of rebounding this month, I think it's more or less, similar to what we have seen seasonal in the past. So it's probably showing that it's too early, to see any impact from the March stimulus, right? It's only the first month. We think we might see more evidence or more support maybe coming, feeding from the second quarter.
Eric, thanks so much for joining us. That was Eric Ju there from Bloomberg Economics, and we'll have Plenty more ahead as we digest this tariff news this morning. The Chinese markets are lifting off the lows of the day, but still, I mean, we are in negative territory. We'll have plenty more ahead. This is Bloomberg.
Right, welcome back. An update of these markets just about across the board. Still some losses, although it's worth pointing out in China and really to some extent in Japan, for example. We're coming off lows a little bit, but make no doubt this is still a very risk-averse session out there. 1.4% to the downside. We're looking at S&P futures about 2.7%, where they have roughly been trading for the most part of the Thursday Asia-Pacific session. Flip the page, please, and have a look at currencies and havens. And to think to the point that our guest earlier on out of Standard Chartered mentioned as well, it's a counterintuitive move because you're getting the low yielders and the havens actually the worst hit from a tariff perspective. So there might be that sort of overlay of an aberration there. But do expect them to come back a little bit. And of course, as far as some of the potential longs are concerned, look at the pound against the euro, for example, given that the UK was relatively unscathed. And of course, the loonie also plays into that story as well. Right, bond markets, here we go. Yields down still. We were down, though, much more by about 10. We're now down about 5, as you can see on some of these 2 and the 10. Aussie still down about 12, and Japan is now down about 8. We're splitting the difference between the low and the high of the day there on the Japanese currency. And, Belle, you're also looking at commodities as well here.
Yeah, commodities have really been in focus because gold, for instance, has touched a fresh record high. Again, you're seeing that sort of haven demand. But otherwise, we're under pressure, and that is unsurprising when you've got tariffs that are being applied across the board, a minimum 10% on all exporters to the US. So a day really of risk aversion, even though, as we said, we've seen Chinese markets starting to improve a little bit, the sentiment there. Very much in the red across the board. Crypto as well, under pressure. Welcome back to the China Show. Taking a look at how the Hong Kong session is faring. We're 30 minutes into trade so far, and look, it's not quite as bad as when the market came online today, but it's not looking that great either. And there's a lot of different names that are bearing the brunt of this. E-commerce, for instance, and essentially exporting stocks, which is, of course, really a lot of the benchmark, Dave.
Yeah, e-commerce, I think when you look at exporting stocks, you look at cars, you look at automakers, you look at car parts makers, you look at some of the suppliers of Apple, for example. So it's really become where people are trying to figure out, and I would imagine some of the numbers are still up in the air, what the tangible impact would be on supply chains, right? Because, you know, who was expecting Cambodia would see a tariff hit of that sort? Vietnam comes online this hour. I'm curious to see how that market fares, of course, given, of course, Vietnam did also catch quite an aggressive bit of the tariff front as well. Now, on top of all of this, too, I think as far as the Chinese market goes, a couple of things. You know, the semiconductor space actually seems to be holding up decently well, and that's keeping the index respectable, at least the index move as well. Now, you look at the e-commerce, the de minimis, of course, and the non-exemption that's happening there. Now, we talked about Southeast Asia and supply chains, right?
Yes.
And Stella International.
China plus one
China
strategy.
plus one, right? We were. Stella is a very good example of, you know, it's a company that effectively makes shoes for a lot of the foreign brands, and, you know, a lot of its supply chain is in Vietnam, for example. You know, we had the CFO on every time they release their earnings, so they weren't too concerned, but I'm curious to see how that they're now looking at the potential impact from that, given that Stella is, of course, quite exposed to Vietnam.
I mean, well, it's got a large factory presence there, and that was their response to the initial tariffs and the initial frictions between the US and China was to establish, again, a manufacturing in another location. But it's a company that produces not just for luxury labels, but also for names like Nike, for instance.
Right.
Yeah, and we saw already the big drop in Nike overnight. Other retailers or apparel makers, Lululemon, for instance, you're seeing it reflected in the session so far today. Again, it's what does it mean for companies or countries that have taken this approach to diversify, and again at the same time, given you've got populations that are skilled and it's already cheap to produce in these markets as well. I mean, is it even really realistic to shift into yet another location? Perhaps not. But President Trump, as we've said, is imposing tariffs on U.S. trading partners worldwide. Asian regions are bearing the brunt. You can see here some of the tariffs are in place. China, 54%. I mean, that's higher than basically every estimate. So the duties are going to be taking effect after midnight Saturday. Higher levies are kicking in on April 9.
It's going to be Liberation Day in America, and it's going to be a day that hopefully you're going to look back in years to come and you're going to say, he was right. This has turned out to be one of the most important days in the history of our country.
Let's bring in Mark Cranfield out of our MLive team as we try and figure out how low risk assets can go the next 24 hours going into the weekend. Mark, we're all yours. What's top of mind for you right now?
How do we get out of this? Where's the exit door? I think that's you got a universal mood here of people. First of all, they just want to de-risk. If they haven't already, they're just racing to the sidelines. They want to get out of equities, get into safe haven bonds. The Japanese yen obviously is doing pretty nicely, and gold as well. So all the typical places you would expect. The big question marks will be for people is like, how much further does this go until we start to see areas where there's relative value and those kind of questions come into play. I suspect in the major markets, you look at the US, for example, or anywhere else, if they haven't yet fallen 20%, people will be looking for the possibility of the US market maybe even coming to a 20% sell-off. And then maybe you start to see people say, okay, now enough is enough, and it starts to make some sense. The next few days are going to be extremely volatile and erratic. That people are going to get used to a series of whiplash days. We still haven't heard much from the European leaders, for example. They're obviously going to have their say on what kind of reciprocal moves they will make against the United States. We're probably going to hear a bit more from China as well. So they'll be back and forth on these. We may even hear some US leaders modifying some of their approach. Traders will be listening to every single word. You'll see a lot of knee-jerk responses. Algo trading is a very big thing these days, and they just respond to the headlines, even if they don't really know much as what behind it. But the underlying theme clearly is that people are scared. This is as bad a scenario as they possibly thought could be. Global trade is going to get hit very severely. People are going to have to downgrade their outlooks for major countries and small countries as well. It's gone, as you were mentioning, even small countries like Cambodia are being hit here. So it really has gone across the board. So very nervous times. In those, people just want to go for the places where there's the highest liquidity. That's one of the reasons why you're seeing the euro do pretty well here. There's clearly, some of this is self-inflicted harm on the United States. And when traders see this, they are not going to be impressed with the US dollar, so they go to the next biggest. The yen move is not a surprise, but to see the Swiss franc and the euro do so well early in Asian trading, that's a little bit an unusual move and may well go a bit further as we get into the European day. So there's a lot of moving parts here, but it looks as though for a while we're going to get used to the idea of bond yields going down. Countries who are thinking about rate cuts will probably bring them forward. We might see even earlier decisions. European Central Bank is the next one. Looks as though they will have to go ahead to lower rates as well to help their economies. We're probably going to see similar things in Asia. People will be getting out their disaster playbooks. This is beginning to look like a crisis environment. Central banks will start to take charge, provide liquidity, and reassure people.
Mark, apologies for interrupting. Breaking news right now. The Chinese have responded. Ministry of Commerce out with some, I would expect, fairly strong lines coming through here. They strongly oppose U.S. tariffs, point number one. They are promising countermeasures to safeguard interests without going into what those countermeasures might be and when we could see them. They're urging the U.S. to scrap unilateral tariffs. They're calling for a dialogue to solve these disputes. And China is urging, again, the U.S. to scrap what was announced. Not to say that probably they're not going to listen, but certainly, Mark, can I bring you back in here? A lot of people have been telling us the next landmark to watch are China and U.S. trade talks. We heard from Scott Bessent, his interview with Anne-Marie Hordern earlier on. he's urging trading partners and counterparties not to retaliate because that would simply worsen the tariffs that are already there. Can we look at the current state of tariffs and narratives as the worst case scenario, and we simply work our way back from that?
I don't think we can. I think you're already starting to see the first sign of China's countermeasures is the movement of the yuan this morning. That fixing was pretty significant. It's unusual for the PBOC to jump the fixing by 100 basis points from day to day, unless they're trying to tell the market that they want it to move in a certain direction. That was a very significant move. And if you look at where the onshore CNY is already trading today, it's at 734.40. The way it's going, we're going to be testing the daily limit, the 2% range, before too long. That doesn't happen very often in the Chinese market, unless the PBOC is trying to tell you something, that they're ready to use the yuan as a weapon. They haven't fully done it yet, but they're clearly sending a signal to the United States. We have got the currency as one of the things that we can use here. So yes, there will be negotiations. Investors will be looking for a dialing back from both sides. But clearly, China are also showing that we have tools we can use here as well. Look how much they used the yuan in 2018, 2019. They moved it by the currency by a significant amount. If they do something similar this time around, we're going to have a global currency crisis. So they do carry a lot of weight, and the United States also needs to recognize the power of the yuan as well on the impact it can have across currencies in Asia and across the world as well. So we already, even though they might not be putting details onto what their countermeasures are, just the movement of the yuan alone is telling you China is not taking this lying down.
Mark, thanks very much. That was Mark Cranfield there, Bloomberg MLive strategist. And just as we've been discussing there, Thailand as well is coming out and saying that they hope to negotiate the US tariffs. That's according to AFP. And also that they've got a strong plan to handle US tariffs as well. As Mark was saying there, though, China isn't going to be taking this lying down, and they're saying, again in this MOVCOM statement, but saying that US tariff measures are typical unilateral bullying. But let's bring in Si Fu, China portfolio strategist at Goldman Sachs, who's joining us in studio this morning. So let's start with the reaction and how you're reading it over at Goldman this morning. I mean, your estimate, as you were saying before, which was pretty much in line with a lot of investors, that we'd see tariffs of around 20%. Yeah. So this far exceeds your expectations.
Yeah, that's what we've heard or we will see in the market as well. Before today, actually, most investors feel quite relaxed about the tariff risk. We were marketing globally over the past 2 to 3 weeks, and what we feel is people generally factor in around 20% tariff increase based on what has been implemented, and that can be digested. Partially offset by domestic policy easing and partially offset by the AI optimism, so people are turning more bullish on China despite the tariff risk. But definitely today's news, I would say it would be a surprise to most of the investors. It's out of expectation. So I think most people are busy re-estimating how the impact it could be. But what I can share is before the event, we do hear some discussion why people feel relaxed about the tariff risk this time compared with 2018-19. A few reasons I feel still valid. One thing is when people think about the company fundamentals, many Chinese companies, they become more competitive in the global markets. Even with the tariff impact, for many products, the price is still competitive. And at the same time, many companies begin to build their brands. So it's still difficult to replace them for global demanders. And the other thing is many companies have already taken into consideration about potential tariff impacts. So they reorganize their supply chain as well. So that's why we are seeing a moderate impact if the tariff increase is similar as 2018-19. The other thing is if we look at currency, before today, it remains quite stable. So different from 2018-19, RMB depreciated quite a lot. But this time it remains stable. If we think about the equity market impact, it will have less impact because the offshore stocks will suffer if RMB depreciate because of the translation loss. So these are the key reasons why people feel more relaxed, and last but not least is people expect possible negotiation. Right. So that's why we think after today's announcement, definitely people need to rethink how much impact it could be, especially on tariff. People are also considering a potential tipping point. If it's reached to a certain level, then the impact may come through. So a lot of people are closely monitoring the export data to see if there's any weakness. So that's how we see this.
What's your message to Goldman clients? What do they do over the short term? And does it change anything over the longer term?
Yeah. Definitely in the near term, it causes more volatility, especially in terms of sentimental valuation impact. It's unavoidable, especially when U.S. market, global markets are all correcting, then definitely for China, we are expecting more volatility. But on the other hand, if we want to position within the China market, we recommend investors to focus on domestic-oriented sectors, like consumer sectors, cyclical sectors, which may also benefit from domestic policy easing. So if we have more tariff, definitely from the domestic side, we will expect more fiscal stimulus on consumption. At the same time, we will expect like more boost on other aspects, including infra investment, etc. So these are the areas which could be relatively safer. So if investors are still consider the relative performance within the China market, these are the areas we recommend.
There's estimates, and I know you're still crunching your numbers, so I want to ask you about your ones, but there are estimates that this amount of duties could shave up to 2 percentage points off Chinese GDP. Given that we had been seeing these sort of green shoots emerging in the Chinese economy, do you think that they still remain, or is this negative enough to really pull China back in the progress it's been making in terms of economic growth?
Yeah, we estimate previously if there's a 60% tariff increase, it may drag GDP by 2 percentage points without considering like fiscal offset. So we do think fiscal will be more bullish to offset some of the impact, but not fully, if it's 2% GDP drag. At the same time, we will expect RMB to depreciate a little bit also to boost the export a little bit. So that's the situation we were considering if there's a 60% tariff increase. But currently, we are still re-estimating all the different dynamics because this time around, we are seeing a universal tariff increase. So for our other countries, we are also seeing the tariff increase, which means a little bit less pressure on currency. So a lot of changes happened this time around. So that's why we also need to take them into consideration.
Yeah, it's a new world, isn't it? Thank you so much for taking the time to come here. And of course, we know it's going to be a very busy day for you. Hi to your team, and good luck today. Get a lot of coffee. We need a lot here too as well. Si Fu there. China portfolio strategist at Goldman Sachs. As we were just talking there, we probably saw it already, the response coming to the Chinese, the initial response coming out of the Ministry of Commerce. Not a lot of detail as to what those countermeasures that they're promising will be and when they will put that in place. Coming up on the show, still in tariffs, but we're shifting focus now to a part of the world that's really come under tremendous pressure in that, do we call it a graphic that the president is holding there? Cambodia, Vietnam, Thailand, the Philippines, and many others in Southeast Asia coming under the brunt of this. We'll be joined by Ruchir Desai out of Asia Frontier Capital. They invest a lot and heavily into Vietnam. We'll see how that changes their market rundown.
And just to note as well, the Vietnam index has just come online and a drop of more than 3% at the open. So we'll have more ahead on that next. This is Bloomberg.
Right, welcome back. You're watching the China Show. We're still measuring, well, first we're observing the fallout in markets, and we're trying to measure what this means really for earnings, for growth in a lot of these countries where, to be honest, who was expecting Vietnam to see a nearly 50% tariff, right? And, the China Plus One strategy, how do we need to be thinking about that, and supply chain strategies from a corporate perspective. Let's bring in Ruchir Desai, fund manager at Asia Frontier Capital. You guys, of course, dabble into Vietnam By the way, thank you for coming in very, very last minute. Market's down, let's call it 3% in Vietnam. How are you looking to change your investment exposure right now?
So I think, like I was telling you earlier before the show began, I think it's very difficult to make a bullish case for Vietnam at this point in time. The initial market expectation was about 10-15% reciprocal tariffs, but this number is 46%, so 3 times what the market was expecting. GDP growth, will be hit quite hard if these tariffs remain in place. It's remained to be seen whether these tariffs will remain in place for the next 1 or 2 years. So obviously there's a big impact on GDP growth, and the outlook for GDP estimates will be downgraded, I think, quite significantly in the near term if these tariffs remain. So like I said, it's difficult to make the bullish case for Vietnam now. Anyway, we've been, for example, our fund has been quite underweight Vietnam over the last 2 quarters, not because of just tariffs, but other issues also in the domestic consumption and the anti-corruption crackdown. So I think I would maintain my weight now. I think it's difficult to make a case to increase the weight, even though the market corrects, say, 5-6% or 10% from here.
You said that you're expecting revisions downward for estimates for GDP. What would be the magnitude that you'd be expecting?
Yeah, I mean, look, if you look at the government estimates, they're pushing for 8% GDP growth. But I think that anyway wasn't realistic even when they announced that. But if you look at some of the estimates from the IMF or the World Bank or some of the other analysts, it's about close to 7% GDP growth. So, if there was a 10 to 15% reciprocal tariff, the estimated hit on GDP growth is about 0.5 to 1.5%. But if it's 46% and it remains in place for 12 months, then you're looking at a pretty significant hit, so maybe close to 3-4 percentage points off 7% GDP growth. So pretty serious hit too for Vietnam, because also you have to remember that exports is a very large part of Vietnam's GDP. Close to 90% of GDP is from exports. So it's a pretty serious issue for Vietnam.
Are there specific sectors that stand out to you as... Let's avoid those sectors for now from an investment perspective.
Yeah, I think it's pretty simple to avoid. I mean, in general, broader market sentiment will be quite negative. So I think I don't think you'll see a sector-specific sell down, but I think you'll see probably a higher sell down in export-dependent names, so ports, logistics, textile garment exporters, seafood exporters, ones who are exposed to, in general, exports and also specifically U.S. export markets. Those will take a hit. And also industrial park companies. They benefit a lot from the foreign direct investments coming into Vietnam over the last 5 or 6 years. But if you see, for example, if there's uncertainty on the tariffs going forward, then would a foreign company go and invest in Vietnam? So that could affect the industrial park companies.
Yeah, that's what I wanted to ask about. What's the biggest impact here? Because there's sort of 2 different things. Not only do you have businesses that have already established in these countries like Vietnam or Malaysia, and it's difficult to see how they can really rapidly shift away given the infrastructure is already in place. But is it more the impact on that front? Or to what you were just saying there, is it more on the impact that it deters further investment into these countries?
So it's a combination of both factors, right? So one is obviously what is already there that could possibly slow down because exports would potentially slow down at this high tariff rate, especially to the U.S. So that automatically impacts these companies. Plus, it also affects domestic consumption, which, for example, since exports is almost 90% of GDP, it generates a lot of employment. So that affects domestic consumption in the economy as well. But the second part of your question, future investment also could get impacted because obviously this leads to a lot of uncertainty. So the kind of numbers you saw of $20 billion of FDI coming into Vietnam over the last 5 or 6 years, possibly that could slow down if these tariffs remain in place.
Apart from Vietnam, did we miss anything? What else are you invested in, or what's busy as a fund manager looking at your mandate right now?
So, I mean, like I mentioned, I think Vietnam, we've been relatively underweight compared to other fund managers or compared to the market or the index. It was the highest weight in September, about 16%. Now it's about 10%.
Right.
So larger weights are more economies which are more focused on domestic consumption, less exposed to exports. So, for example, South Asian frontier markets like Bangladesh, Pakistan, Sri Lanka, where exports as a percent of GDP is 10 to 15%. It's not impacted by all these tariffs. And also Central Asia, Kazakhstan, Georgia, Uzbekistan, again, low exposure to exports. So I think these 2 regions possibly, if this high tariff environment stands out, I think it's a good place to be on a relative basis compared to, say, Vietnam or Southeast Asian economies.
How do we need to be thinking about the currency now? How do you think about currency exposure or the policy offset, that whether that's Vietnam or Bangladesh or Pakistan, for example, because that goes into your math?
If you look at South Asia or Central Asia, especially South Asian frontier economies, they all had a tough time between 2022, 2023, 24. So you've seen significant currency devaluations across Pakistan, Sri Lanka, and Bangladesh over the last probably 2 years. And those currencies have bottomed out. So I'm not so concerned whether the dollar gets stronger or the Fed holds rates or raises rates from here. I think they've already come out of the crisis from a macro perspective. And therefore, you will see some amount of currency depreciation, which is normal for any emerging market economy, 3-4%. But I don't see a massive devaluation in these economies. And with respect to Vietnam, yeah, I think you've already seen the currency weaken over the last probably 6 or 9 months. Maybe that continues going forward as well.
Ruchir, thanks so much for joining us in studio this morning. That was Ruchir Desai, their fund manager at Asia Frontier Capital. And there's more analysis ahead on the tariff impact on Southeast Asia's export-oriented economies. We're going to be speaking with HSBC's ASEAN economist Yun Lu joining us in just a few minutes from now. So more ahead. This is Bloomberg.
Right, welcome back. You're watching the China show. These headlines are coming in still thick and fast here. Why don't I take Thailand? And yeah, let's start with that. So the government is, well, I think for one, let's start with the good news here. They're still aiming to meet the GDP growth target for the year 2025. A couple of minutes back, they also mentioned that they're looking to finalize tariff negotiations with the U.S., not tariffs on the U.S. So I think that's important, that they are open, of course, to having a conversation.
Yeah, and I'll talk about Japan as well, because we've been hearing this morning from the Chief Cabinet Secretary Ayashi speaking in Tokyo, saying that they're going to ask the US to be exempt from these tariffs, essentially, and that they're also going to be ready to offer funding support to business as well. So they're continuing to analyse, essentially, the impact. But it's not just Thailand, Japan, there's also the Philippines as well.
Yeah, they're looking at it looks to be an industry group is looking, well, effectively saying that exporters may raise their prices given the imposition of tariffs, which I should mention on an absolute basis, the Philippines actually coming in relatively unscathed compared to the rest. We'll have a conversation with HSBC. The ASEAN economist joins us in a couple of minutes.
Well, we're continuing to digest really what has been a very heavy news flow this morning, relationship, of course, to tariffs and that have been announced. But also we're hearing that Stellantis is planning to shut its Canada plant for 2 weeks. That's what the union is saying. They made that announcement in a Facebook post. But taking a look at some of the bigger suppliers, I mean, we've already seen them under pressure, but they're still continuing to be in the red today. Yeah, and you want red? More red coming up. Here you go. So most of the sectors are down. I mean, this one actually looked much worse about, let's call it 45 minutes back. We are getting a bit of green on your screens, but make no doubt, this is a very risk-averse session. 1.3 to the downside, Asia Pacific. The dollar is, we're seeing some downside. Yields are actually down quite substantially in the Treasury market. And as you can see, S&P futures are off by about 2.7. And this actually is a good thing if you compare that to what we're seeing across the NASDAQ future. So, yeah. Okay, we have more lines coming through. So we had the Thais coming through out of the Philippines. Now we have the South Koreans coming out. They're actively going to seek talks with the U.S. to discuss tariffs. So this is a fast developing story, and we'll keep on top of this, get you more details once we have more, of course, coming out of the South Korean side. In the meantime, of course, at the center of this, you could argue, is really China. 50+% tariffs. Unexpected as far as that absolute number is concerned. Let's bring in Stephen Engel, our Chief North Asia correspondent. He's been covering the story from the get-go. Yeah, Steve, we're all yours.
Look, you've already gone through the headlines. China is vowing to defend its interests, obviously, with countermeasures. We don't know what those countermeasures are going to be, but I'm sure they have them basically in the bazooka ready to go if and when they need to fire it. Perhaps when those tariff actions from the Trump administration, increasing it cumulatively since the Trump administration had its second go. 54%. Now, the confusing part of that is Bloomberg Economics is saying this basically takes the total average tariff on Chinese goods to the United States to more than 68%. That's going to pretty much wipe out 80%, they say, of U.S.-China trade over the coming years, which would have also spill-down effects with the China Plus One, with the China, not only China, but Apple and other companies in the United States diversifying their sourcing and supply chains to Vietnam, to Indonesia, to Thailand, to Malaysia, to India, which have all gotten double-digit tariff increases as well. So, again, just to run through the Ministry of Commerce statement saying the U.S. tariffs seriously damage the rights of relevant parties, strongly oppose them. The acts are typical unilateral bullying, and they are urging the United States to scrap these unilateral tariffs, and they're calling for dialogue to solve disputes. They've not had dialogue. They've had low-level discussions, obviously, which have been bogged down as Donald Trump has been, dare I say, preoccupied with Canada and Mexico, as well as the Ukraine crisis. China, I was in China, 20 of the last 30 days. Hearing from them, they were expecting and willing to deal with maybe that 20% tariff, but adding on now another 34%, bringing that effective rate to 54%, potentially as high as 68%. This is going to severely, as according to even Bloomberg Economics, severely harm China's GDP growth to the tune of minus 2.8%. So that's significant for a country that saw 5% growth last year and is aiming for 5% right now. They're trying to boost domestic consumption, but that is like turning a supertanker. It takes some time. So buckle up, buttercup, right? But, you know, I just want to make one more point because we have this soundbite from Scott Bessent, the U.S. Treasury Secretary. On the crux of the tariffs, up until today, was fentanyl. Yeah. So if China wants to get rid of those 20%, according to the White House, they need to tackle and address the fentanyl issue. This is what, again, Scott Bessent had to say.
I think China said today that solving the fentanyl crisis depends on taking off the fentanyl tariffs, and I'm pretty sure that's not the way the sequencing is going to work. They're exporting the precursor chemicals, and every day, every week, every month, Americans are dying, and it's going to have to stop.
So again, I think China needs to refocus its calculus on how to respond to not only that, because up until now, they've said it's not a China problem, it's a U.S. demand problem. Now, with this added, worse than expected, as Li Qiang, the premier, said at the China Development Forum, we are expecting the tariffs from the United States or the shocks from abroad to be worse than expected. And sure enough, these tariffs that we see them right now are worse than expected.
But you hear Scott Bessent talking there about sort of the sequencing. I mean, China wanted these tariffs to be repealed before they even got to the negotiating table or said that they would start to do something about fentanyl, for instance. So the two sides are so far apart. These tariffs are so much greater than what was expected. How do they even start to get to more high-level talks?
Well, I think China has been fairly measured in its response so far. They've not used every lever that is at their disposal. Of course, they cannot do tariffs like for like because of the imbalance of trade. Basically, China ships to the United States 3 times more products than the United States ships to China. But they do have, and they have used, export controls, entity list additions, appeals to the WTO. They've made a number of different steps. They've curbed purchases of U.S. agricultural products, beef, wheat, corn, soybeans, and the like. There could be further measures like that. We saw a story earlier today from Bloomberg News citing sources as saying the NDRC has instructed Chinese companies to put on hold for now investments in the United States. What else could we see coming down the pike as far as export controls on rare earths? Also weaponizing the yuan. I hate that term, but essentially is to allow the yuan, which has been very stable through this turmoil, to allow it. We're seeing the yuan weaken to 7.3 from 7.27 roughly. So there is perhaps a little bit more of a weakening allowance by the PBOC. But I think we're going to start seeing without dialogue, without high-level meetings between Xi and Trump, either by phone, I don't care which way, do it over WeChat, do some sort of conversation. So then you're going to see, without that, you're going to see retaliatory steps as China has vowed, whether it's today or when those tariffs actually take place.
Yeah, any sort of dialogue is better than no dialogue at all. But that's our Chief North Asia correspondent, Stephen Engle, there, and taking a look at the market reaction to this, because it's being felt across different corners. But some markets or some parts are being more impacted than others. So you're seeing it really very much in these apparel and e-commerce names, for instance, this morning. So these are companies like Stella we were discussing earlier, ones that have already tried to diversify away from China, create that China Plus One strategy. So not only do you have manufacturing in China, you've got it in Southeast Asia, and it's not looking that great with this amount of levies that are being applied. But you're seeing it as well in names like the home appliance makers, Medea, for instance, e-commerce names as well. That's all about this de minimis exemption rule that's going to be essentially scrapped. But there are some brighter spots as well, and these are names that could benefit from Beijing's response, how they try to to continue to grow those green shoots in the economy and to stimulate things like domestic consumer demand?
That's a good point, because the response from China might not necessarily be a direct response to the U.S., but fixing your house, as we were just pointing out there, right? So this is really a bright spot across this equity market. The other thing we want to mention here, because as Steve was pointing out, weaponizing the Chinese currency. What the chart actually shows you, and thank you for the zoom, the white line is the fix of the day. The red line to the top, that's the 2% threshold beyond which the onshore rate is not allowed to move. You have two lines there. You have a yellow and you have a green line. We're nearing the upper end of the trading limit. The small uptick you see rightmost side of your screens is an indication of highest fix or the weakest fix of the year so far. So the PBOC is giving somewhat, to the point of Mark Cranfield, somewhat of a green light to the market. Yes, we can trade slightly weaker in the currency because of what's happening, but the fix will remain an anchor for the Chinese currency. Plenty more ahead. This is Bloomberg.
You're watching The China Show, taking a look at how Asian currencies are faring this morning. And there's really a very clear read across on the screen today. So you've got Trump that's announced these tariffs. They came in a lot higher than what some estimates had been. And they're also really targeting a lot of countries in Southeast Asia. So you can see that flight to safety with the strength in the Japanese yen. And then again, you see the bearing that these duties are going to have on countries, again, in this region, the Thai baht, the yuan, Korean won, Malaysian ringgit, really under pressure so far today.
Yeah, I'd like to thank my producers for flashing that 0.25 size font for us to try and
wasn't easy.
Read and get around. That looks like the Japanese yen. It is the Japanese yen, isn't it? Okay, let's get a sense of EMFX right now. Marcus Wong joins us, Bloomberg Emerging Markets macro strategist in Singapore for us. Marcus, we're all yours. What's top of mind for you?
I think what's interesting to note is that the reaction from emerging Asian currencies has not been as drastic as one would expect. You look at the biggest losers, I think, in the region, won, baht, ringgit. Actually, they are down by about less 1% or so. And I think, in the sense that it ties back to, what people are expecting moving forward. In the sense that, they see this as just a starting negotiation point. And they expect, as further delegations to the US, to and fro's, wheeling and dealing, and possibly, that for the ultimate tariffs to be actually lower than what was announced last night in the Asian hours. So I think, they are taking comfort in what, the Sen has said, that there's room for negotiation. So looking forward, what will be pivotal for Asian currencies is how Asian governments react after this. There's a sense, of course, that, economies for like Australia and New Zealand that do not retaliate. But, there's also the sense of the market that China or EU may announce tit-for-tat tariffs. And therefore, I think the quantum of tariffs announced in this retaliation will be important, as this could actually signal escalation or de-escalation. So moving on from there, other things that investors are really looking out for is whether, for example, PBOC will de-anchor the yuan. But what we've seen today is that they kept the yuan reference rate below 7.2. But will they keep it as such moving forward? And if this global tensions escalate from here, will we see actually intervention from Asian central bankers, which have intervened quite heavily in the past few months, past 6 months to a year as the dollar rallied? Again, if they intervene even more, they might actually get further, focus from the Treasury Secretary, for example. But that said and done, one can expect at least until April 9th is expected more volatility and uncertainty, as we expect more wheeling and dealing to be done.
So, Marcus, the S&P, South China Morning Post, has been saying that Chinese President Xi Jinping is going to be visiting Vietnam, Malaysia, Cambodia in the next couple of weeks. If you see more trading that goes on between China and its partners in this region, how much does that sort of offset the impact of these tariffs?
I think, investors, we look at the playbook of the first comes, first term. Essentially, there was a lot of offshoring. There's a lot of the movements of supply chains out of China into Southeast Asian economies, essentially to avoid, the tariffs on China, back in the first trade war. But this time it's different. US reciprocal tariffs have hit cross-border. What this could mean essentially is that there's more intra-regional trade between Southeast Asia and China. I guess, this could really take it a step further. This could even bring about more internalization of the renminbi in a sense. So all of these are just preliminary talks, of course, but I mean, this could actually, over a longer term, be a structural shift in how trade is done in this region.
Marcus, thank you so much. Marcus Wong, our Bloomberg Emerging Markets macro strategist. Really, let's zero in even further within the EM space and have a look at Vietnam right now. So I'm looking at the benchmark. We're down 5%. That's the biggest one-day drop, get this, in about 4.5 years now. The last time we saw a move this bad was in January of 2021. Let's have a look at the dong on the softer side of things as well right now, as you would expect given the news flow right now. There's the dong standing out for you right now. Let's get a sense really of what this means for the China plus one offshoring strategy, what it means for the economy, particularly in Vietnam, where the magnitude of that tariff really coming in as a massive surprise to the upside. Joining us here on set is Yun Liu, ASEAN economist at HSBC. She oversees, of course, Vietnam along with the ASEAN coverage there. So let's start with Vietnam. How do I need to be thinking about the economic fallout here?
Well, I mean, obviously, we're seeing quite a lot of the downside risk to growth here. President Trump announced 46% tariffs on Vietnam's imports here. So the way how I look at it is it's not really, through the trade transmission part. It's also through, the FDI part. I mean, on trade, Vietnam is really dependent on the U.S. market. 30% of Vietnam's exports actually go to the U.S. market, which means that if, say, the U.S. imposes the tariffs on Vietnam, then it will be harder for Vietnam's exporters to find alternative markets in the near term compared to peers. And then obviously, there is the FDI part here, right? I mean, Vietnam has long been regarded as the main beneficiary of China plus one strategy here. And that's why it partially explains, this booming trade with the U.S. So the tariffs will also put, the investors on a very cautious footing, at least in the near term, in terms of where to put their new disbursements.
So what are Vietnam's options then? What can it look to do? I mean, we're already hearing from a lot of governments this morning, like Thailand, for instance, in the region, that are saying that they're going to be trying to open negotiations with the US. But beyond that, what else can officials do?
Well, I mean, trade negotiations is definitely one option. And from now on to April 9th, we're probably going to see a lot of delegations in Washington, D.C. in terms of, getting maybe a better outcome through trade negotiations. But I guess the other thing is also here what Vietnam and other ASEAN markets need to think about is how to diversify your market here. Because when we look at the export exposure across ASEAN, then Vietnam really has the highest exposure to the U.S. market, to the U.S. demand here. But I think one good thing about Vietnam is it's the only EM market in ASEAN that has a free trade agreement with Europe here. It also does a lot of trade with China. So maybe, shift your focus to other regions and try to use it as sort of, offsetting factor here.
Yeah, and I think, there is to your point, I want to talk about this later on, there is a domestic focus here,
yes.
Domestic resilience story in some parts of ASEAN. But I think before we get a final question, so I was looking at when Donald Trump flashed that card, I'm not sure what it was made of. So he had two columns, right? One is the reciprocal tariff, or discounted tariffs, how he phrased that. The other column was the tariffs those economies charge on the U.S. I'll read you some. Vietnam, 90% tariff charged to the U.S. Malaysia, 47%. Indonesia, 64%. Cambodia, 97%. What do you make of those numbers? Are those the actual tariffs you think those countries charge to the U.S.? In other words, are those negotiating tools that they can bring down when they go into these talks with the U.S.?
Well, I think, a lot of what President Trump refers to this, reciprocal tariffs, as in, the tariffs of the U.S., of, say, Vietnamese products into the U.S. and that differential, with the U.S. products into Vietnam. So I think what Vietnam also has already signaled its willingness, actually this week, before, the so-called liberation date, is that Vietnam is set to reduce that tariffs for U.S. products, then paving the way to purchase more U.S. products and voluntarily reducing that trade surplus with the U.S. And it's quite massive with the U.S. So I think there's still a lot of room for negotiations.
On the monetary side, we've sort of seen central banks just holding back on any sort of decisions as they awaited this, and also the inflationary impact from a global level, I guess. But what becomes the key focus then for policymakers, do you think?
Yeah, so I think for a lot of the ASEAN policymakers here, really there's a tariff risk, and actually increasing tariff risk may prompt them to do more or front load a lot of the, let's say, monetary, maybe we'll see more rate cuts or at an early stage. In terms of fiscal spending, actually, I think ASEAN, there's still good pockets of resilience in terms of that, getting more of that policy stimulus. If we look at the budget announcement across ASEAN, a lot of the countries trying to revive the old playbook, as in, really prompting this infrastructure spending to alleviate part of that risk accident. And this is a playbook that Vietnam specifically wants as well.
On the monetary policy offset, we have a couple of central bank meetings, I think, coming up next 2 weeks. I think the BSP is coming up in 2 or 3 weeks.
BOT as well.
BOT, I think Singapore might as well. Just your expectations for those.
Yeah, so the very first one is going to be the MAS meeting here. And I think, for the MAS, is very much preparing for the rainy day. So we have actually just changed our call, bring up our next easing move from July to April. I think all signs are actually pointing to the same direction, especially, with the growth uncertainty here. Singapore, if we look at the tariff here, Singapore only got 10%. That being said, because Singapore is such an open trade economy, it has heavy trade openness, that any turbulence in the global trade picture will, likely weigh on Singapore's growth here. BSP very much, likely would go ahead with 25 basis point rate cuts here. BOT here, I think it's also sort of a debate. Last time when the BOT said the bar for the next rate cut could be higher, but, things have changed. We have penciled in a 25 basis point rate cut later in the year, but let's see how it goes. I think, it will probably increase the likelihood of them front-loading the rate cut.
Some countries as well stand out, and I think you also want to ask about Malaysia, Dave.
I think that's where you're going.
You can keep going there, but I was going to go. You're talking about ones that are relatively insulated, more domestic-facing.
Yeah. Where do people not have to worry?
Well, there are some pockets of resilience within ASEAN. So despite all this tariff uncertainty we're seeing, on the external front here, I think it's also important to look within, try to search, inner strength here. And here, Malaysia is a very good example here. Malaysia is also very much trade-dependent economy here. In terms of private consumption, it's still quite decent, partially because of the ongoing generous subsidies. Obviously, the government aims to cut some of the RON 95, the petrol subsidy rationalization in the middle of this year. We'll see how that will pan out on private consumption. But on investment here, obviously, FDI here, we may have a little bit of caution in the near term. But for public infrastructure program, all these mega projects, really Malaysia is seeing, witnessing an investment boom here. That's why when we look at Bank Negara, Malaysia, it is actually the only central bank in ASEAN that has sound still relatively neutral about its, structural outlook here.
Right. Yoon, thanks very much for joining us. That was Yoon Liu, the ASEAN economist, at HSBC, as we really digest these tariff implications and which countries in Southeast Asia are going to be hardest hit. And Vietnam, of course, really standing out. And you're seeing that reflected in the market reaction today. Hong Kong stocks and mainland China as well, still in negative territory, off the lows of the day. But again, China, the tariffs there higher than what most had predicted. We'll have plenty more ahead. This is Bloomberg.
All right, damage reports. We're going into the 90-minute mark here. What's a good way to spin this? We're massively off the lows of the... Okay, go.
Yeah,
I think you have something.
It's not as bad as when we started the session. That's the silver lining.
And you compare to Vietnam, we are doing much better in Hong Kong. Vietnam is down the most in about 3 years still. But make no doubt, the markets are trying to still literally analysts are literally on their Excel files right now, and hopefully with an AI tool, trying to figure out what the earnings impact will be, really, because of the tariffs taking place.
And also GDP impact, the economic implications. This is much worse, the tariffs, than had been expected by many